Good afternoon, everybody. I'm Peter Worley. I'm the Head of Restructuring and Insolvency at James Cooper Preston, and I'm going to be assisted on this webinar by Tom Russell, who is one of our senior managers.
Good afternoon, everybody.
It's good to see we have a strong attendance for this lunchtime webinar, so thank you all for joining us. You will, I hope, already seen on the first slide that we have a headline, which is what it's about: pre-pack administrations, are they a virtue or a vice? And we have a quote from Dr. Cable, which he made when he was still Secretary of State for Business, about pre-packs, and this alludes to the concerns which he felt were widespread about potential abuse of the pre-pack process. I think I would like to begin by making what would seem to be a pretty obvious point, which is that I spent quite a lot of time getting my license to do insolvency work, and I know my colleagues feel the same way, that we would not want to put that license at risk by simply colluding with somebody to buy back a business cheaply when we don't know them. We're meant to be independent. We've never had any dealings with them before. Why would we want to put ourselves in the invidious position of helping the directors rather than helping the people that we're there to work for, which is the creditors? But nevertheless, there are one or two instances of abuse of this process. These grab the headlines and give the impression that abuse is actually widespread. We'd like to begin, if we may, with a poll. So you should see on your screen a question, which is, do you have any clients or customers who have gone into, we say pre-pack here, but administration or liquidation, whatever you want to call it, in the last 2 years? So if you'd like to click on whether that's a yes or a no, and we'll see what sort of experience you've had as a group of the insolvency process. And whilst you're voting, I'll just very quickly run through what the agenda is for this webinar. So Tom will begin by taking you through what a pre-pack is and how this differs from other insolvency processes. And then I'll go on to talk about what's led to the growth in the use of pre-packs and why there is so much public concern about their potential abuse. Tom will then look at the new safeguards which are coming into force, some of them we've had before and the new ones that are coming in imminently, before I complete with whether actually the pre-packing of a business might present you with a business opportunity to acquire. I know at least one of our attendees today has talked to me about potential acquisition of a business from a pre-pack, so hopefully that will be something which will be of interest to you all. So how are we doing? We've got actually, it seems to be quite a lucky bunch really, because we've got about a third of people who say they've got a customer that's gone bust in the last 2 years, whether that be a pre-pack or whatever. But 2/3 of you seem to have been successful in not having a bad day, which is good to hear. So hopefully you'll be more interested in the opportunities that we're going to talk about rather than the risks, but nevertheless we'll cover that area as well. So Tom, if I can hand over to you, and we'll get cracking on what's the difference between a pre-pack and any other insolvency.
Thank you, Peter. The first point to bear in mind about administration is that a company can only go into an administration if it's actually insolvent or about to become insolvent. So administration is not a tax planning tool or anything like that. There are some formal tests for insolvency which are set out in statute. Broadly, these are a cash flow test, and which is where the company doesn't have sufficient monies to pay its creditors in full, or a balance sheet test where its liabilities are greater than its assets. In addition to filling one of those tests, however, the proposed administrators need to be satisfied that the purpose of the administration has a reasonable prospect of being achieved. These purposes must be considered in turn. The first purpose is that of rescuing the company as a going concern. Now, whilst this objective is laudable, it's very rarely achieved in practice. And in that case, the second objective of achieving a better result for creditors than would be achieved in a liquidation is the next purpose that needs to be considered. If neither of those purposes can be achieved, then the third purpose of realising property for the benefit of secured or preferential creditors, broadly preferential creditors are employees for certain claims, and not incidentally HMRC as was the case in the past, then the administration can go ahead if that objective can be realised. Now, if none of those purposes can be achieved, then an insolvent company is generally forced to go straight into another process called liquidation. Now, in an administration pursuing objectives, either number 2, the better result for creditors and liquidation, or number 3, realising property, the proceeds of the sale of the assets are used to pay costs, and then thereafter the creditors are paid in an order prescribed by statute. Now, if there is an insufficient amount remaining to pay a category, such as unsecured creditors in full, then they receive a prorate sum relating to a proportion of their debt by value. Generally speaking, a better result for creditors will arise in an administration as opposed to liquidation, because it's more practical to sell the business of a company from administration than it would be from a liquidation. This is because the administration can happen more quickly and with a greater protection of the assets by virtue of a moratorium than in a liquidation. Also, the administrator, as an officer of the court and an agent of the company, can have the option of trading that business more easily than in a liquidation. A liquidator will also face personal liability in continuing to trade. Now, I've explained how a company can go to administration. I want to look now at what a pre-pack administration is. Whilst the press coverage surrounding the pre-pack may lead you to believe that pre-packs are insolvency procedures in their own right, in fact the legal framework surrounding a pre-pack and a normal administration are basically identical. The Insolvency Act in 1986 did not mention or indeed envisage the pre-pack process. Now, the differences between the two relate to the timing of the marketing and sales function, and these come about as a consequence of the practical and commercial factors which affect modern entities, as the insolvency practitioner attempts to get the best price for the assets. Now, in an ordinary administration with a qualifying floating charge holder, which in this case is normally the bank, a notice of intention to appoint an administrator will be filed at the court, giving a 10-day moratorium to prevent creditors taking legal action. Now, in a normal ordinary administration, the appointment of administrators would follow somewhere before the end of those 10 days, and he would then seek to market the business for sale, and a sale process would commence and a sale would complete sometime after that. In, for example, a manufacturing business where you have an industrial unit with heavy plant, heavy machinery, this process can work well, and the administrator might even trade that business for a few weeks to maintain supply to customers and retain the workforce. As Peter will detail in a moment, the businesses that insolvency practitioners find themselves dealing with these days are increasingly more knowledge-based entities. Their assets may comprise a few tables and chairs in an office and a computer, and the value in that business rests in the contracts the business has with its customers and the employees it has to service those contracts. Now, at the point in time that the company entered administration and it became public knowledge that it was in administration, the likely outcome is that customers would find different suppliers, employees would go elsewhere, and the administrator will be left with little to sell. Now, the pre-pack administration moves the marketing process to the period prior to the appointment of the administrators. So a notice of intention would be filed in the normal way, giving a 10-day moratorium. And in that period, the administrator would take efforts to find a purchaser, working with the directors and often for that business. In that period, there's a sales process, a negotiation period, and the terms of a contract are broadly agreed. Now, when that's in place, the administrator is therefore appointed, and immediately on that appointment, that agreed contract is signed and sealed, and the sale completes. There's a benefit in that, obviously, in that there's a very short period of disruption where the administrator is involved, and the customers are much more likely to get continuity supply, and employees are given a great more certainty in that regard. I'd like to pass to Peter now, who's going to speak about the growth in the use of prepacks.
Thanks, Tom. As Tom has touched on, where there's a business with a substantial asset base, it's much easier for administrators to continue to trade a business. So if you had a shipyard and it's got orders from the MOD, they can't just go and get their ship somewhere else next week. It'd be relatively simple to continue to trade the business for a period whilst you look for a buyer. But increasingly, businesses that we get appointed over in the UK economy are service-based businesses, which, as Thomas touched on, may only have a few sticks of furniture. The real value might lie in intangibles, but if those tangibles prove to be unrealizable, there's nothing to fall back on to fund the administration. So administrators are much more reluctant to get appointed over businesses with what are in effect very lean balance sheets. The next issue that the administrator has to think about is, can we trade this business profitably? And if one goes back to the recession in the 90s, it was relatively, and earlier, it was relatively easy for an administrator or receiver in those days to reduce costs the moment he was appointed in order to ensure he didn't trade at a loss, but thereby make the business more readily saleable to a purchaser. And redundancies did play a big part in that. And it was, I can remember there being a sort of standing rule that on appointment you would release a third of the people the day you got appointed and retain the other 2/3 and try and find a buyer for the business with them. But nowadays that's much more difficult because of the impact of TUPE, the Transfer of Undertaking Protection of Employment Regulations, which in insolvencies can act in a perverse way to actually prevent people from being made redundant without the cost of that or the burden of unfair dismissal risk or whatever passing to the purchaser. So that becomes another problem. Another consideration for us are contractual arrangements. So increasingly, suppliers to a company will build into their terms and conditions of trade that should the company, the customer, become insolvent, then any contract that might be in place will either be terminated or capable of being terminated. And that could be a problem either in terms of keeping customers, or it could be a problem because you have a key supplier who won't supply, or classically, increasingly, companies operate from leasehold premises, and the lease for the premises might be terminated on insolvency, and without premises you can't trade. Then there's the next question for an administrator: is anyone who can hold us over a barrel? Is there any crucial supplier who or customer who without whom the business is completely unviable? And classic with this will be if you're appointed as administrator of a motor dealer, if you don't have the support of the manufacturer, if it's a single manufactured dealership, the business is unsaleable, and you'd be forced to simply close it down. And then there's a question of publicity, and this is a sort of chicken and egg situation in a way. It's a legal requirement for us to publicise the fact we're appointed as administrators, but very often people don't want to deal with a business in administration because they're concerned that they may not have longevity of supply, that the warranties they may have on products that they would, or services that they would look to get from the company may not be very reliable if the administrator doesn't sell the business and the company closes down. And then this is by no means a complete list, but the last one I was going to touch on here is Are there any regulatory issues? Increasingly, we live in a regulated world where there's issues with health and safety, food standards, environmental issues, and as administrators, do we want to stick our neck in the noose that the directors previously had of breaking these rules? And while some are more easily overcome than others, it is a concern. Nobody wants to find themselves personally liable or locked up in jail for breaching some regulation simply because you're trying to do your job. So that's another reason why administrators may sometimes be reluctant to take office. So you can see there is a rationale for the growth in the use of prepacks. But so why are the public so concerned? Well, we have two fairly naff graphics up there on this slide. One on the left is meant to be a needle and thread and to represent, if you will, a stitch up, which is what people are concerned about. And the one on the right is meant to represent the phoenix, which of course is the bird that rises from the ashes of its own flames. And the concern which Vince Cable's comment on the first slide alludes to is that the administrator comes in, he does a cosy deal with the management, he sells the business back to them without any real thought to whether this is a good deal or not, and off they go with their Phoenix company, no worse off for the experience. So what are the fundamentals where the real concerns that behind such a deal that would trouble creditors in particular and the public in general? Well, the first point that one here is made is that the sale terms are agreed and concluded before the administrator's proposals are presented to creditors. And this came up in a report prepared by Theresa Graham, which Tom will talk about a little more in a moment, that this was a concern of the public. Well, actually, the sale terms are agreed and concluded sometimes where the administrator has been appointed before he markets the business for sale. He doesn't, just because he doesn't do a prepack doesn't mean he automatically consults with creditors far and wide before he concludes the sale of the business. But it's perceived to be more cloak and dagger than following the more conventional pattern of appointing the administrator who then markets and then sells. The next issue is in a situation where the marketing is taking place before an appointment happens, there is a concern that the administrator doesn't bother to find other prospective buyers for the business who might pay more than the incumbent management. Now, my experience of that has been that directors can get quite upset when they realise that you are going to be looking elsewhere for a buyer for their business. But that, our job is to get the best outcome for creditors, the best result for creditors. So that is what we will automatically want to do. Now, that's not to say there will never be a situation where there is not the time or the funds to market a business. If you have a micro business where the value of the business is maybe £10,000, you haven't got a lot of flexibility as to how you market that business. But in terms of larger businesses where creditors could suffer substantial losses, one should be making an attempt to market that business. So arising from those two issues, is any sale on the best terms that were reasonably obtainable? I'd like to think that the answer in most cases will be yes, but clearly if there is a stitch-up, then there is a risk that there could be abuse and the directors could get the business back for, relatively speaking, a song. And then the final point was, has there been any independent asset valuation? Well, this is a bit of a thorny subject in a way, because it's quite easy to value a freehold property. You can get a surveyor along, he can give you a value for that. It's relatively easy to value a Heidelberg press. It's pretty easy to value a motor car. But when you start talking about goodwill, customer bases, know-how, I know there's at least one man on this webinar who gives corporate finance advice, and he will recognise when I say that outside of insolvency, the value of a business is either the higher of its net assets or a multiple of its profits. But in insolvency, we haven't got profits very often. So the value of an intangible is really what someone's prepared to pay for it. An independent valuation of that can be extremely difficult. But nevertheless, that's an area of concern. So let's have a quick look at the numbers. Now, this is a slightly cheating slide in a sense, but the pre-pack review undertaken by Teresa Graham identified that in 2013 there were about 2,400 administrations, of which about a quarter were pre-packs. And some research done separately by the University of Wolverhampton to support the Graham Review looked at 2010 and identified that in that year, somewhere between 60 and 65% of pre-packs were to connected parties. So if we assume that split on pre-packs in 2010 applied in 2013, then of the roundly 580 or whatever it is administrations that took place in 2013, one could extrapolate that around 350 of those might have been pre-packs to connected parties. Well, that across the whole of the UK economy, that doesn't strike me as a recipe for widespread abuse. But the university research also identified some other points. The majority of the companies were between 5 and 15 years old. Most of them were micro or small companies, and most of the reasons for their difficulty were that they faced difficult market conditions. Excuse me. So this doesn't point to companies being flipped through pre-pack administrations once every 2 years with a great detriment to the UK economy. So it does seem a bit hard to understand why the previous coalition government should have been quite so concerned about this as an issue, but they were. And so we have safeguards that were brought in before the recent round of legal changes, but there are changes which are now coming into force imminently, and Tom is going to talk a little bit about what those are. Over to you, Tom.
Thanks, Peter. As I mentioned earlier, the Insolvency Act in '86 didn't envisage pre-packs, and so following public concern, in 2009, a Statement of Insolvency Practice 16 was initially introduced, and this Statement of Insolvency Practice, or SIP as we call it, was revised in October 2013 and is due to be further revised in November 2015, so in a week or so's time. Now, the initial SIP in 2009 introduced guidance for IPs, insolvency practitioners, in respect of their duties and obligations, and it required them to disclose certain information to creditors of an insolvent company which was party to a pre-pack. And the information was relatively straightforward. It included the name of the purchaser, the consideration that was paid, the terms of any deferred consideration, the date of the sale, and any marketing effort that was undertaken. Now, this report, this information was provided to creditors after the administration had happened, after the sale had happened, and creditors could normally expect to get a letter in 7 to 10 days telling them what had happened. The report also allowed for the regulatory bodies that oversee the work that we do to review the IP's conduct in these sales, and a copy of the report with that information was sent to the regulatory bodies. Now, of course, creditors had more information about the sale, but it all happened after the event and didn't actually change the outcome. So the revisions in 2013 introduced a principles-based approach, and the principles related to the role of the IP and more to who they owed a duty of care to at the various stages of the process. So in the outset, you'd be engaged by the company and you might liaise with the directors. You then had a duty as administrator to the creditors, and it set out these duties and reminded the IP of those duties. It also suggested that IPs justify their decision to creditors as to why they thought a pre-pack sale was undertaken. And there was slight amendments in that revision to the information you provided, so slightly more detail. Now that the new SIP, which comes in next month, as I say, continues with a principle-based approach, and it also continues with the theme of justification and disclosure, but it introduces 2 new additions that of Marketing Essentials, as it's titled, and that of the pre-pack pool. Now, Marketing Essentials are really a list of points that the IPs should consider when they market a business. It requires IPs to market the business widely, or if they don't do that for any reason, justify why they didn't. And the obvious reason why they wouldn't is because it would damage any value in the business if the competitors, for example, found out about it and started speaking to the business's customers. But that justification needs to be put forward to creditors. The second major change was the introduction of a pre-pack pool. Now, this was an idea that Theresa Graham put forward in the report that she was commissioned to do into the perceived weaknesses of prepacks. And in her words, the pool is there to satisfy the trustees that sufficient work has been done by connected parties to justify the new company's existence. So the pre-pack pool only comes into play when it's a connected party sale. So that's a sale back to directors or shareholders that were previously involved in the business. Now, the pre-pack pool as is due to come in November 15. It's not operational as yet, but it's set up so that a connected party who wants to put an offer in can approach the pre-pack pool, which is made up of a panel of independent people, with a viability report into the new company that they intend to set up to purchase the assets of the old company. This panel of people will review the viability report and issue a viability statement based on the information provided to them by the new purchaser. Now, it's intended, but not actually required, that the viability statement that the pre-pack pool issues will be provided to the insolvency practitioner, and then they will then disclose it to creditors. But the viability statement doesn't actually affect the powers of the administrator to sell the assets or the business as they see fit. Now, it was envisaged and hoped by Theresa Graham that the input of an independent person would give creditors some comfort that Newco is a viable business, and the pre-pack process actually gives them some comfort. It doesn't really assist the old company creditors unless they actually intend to extend credit to the new entity. But as I say, it's due to start in a couple of weeks, and we'll have to wait and see really as to whether it offers any value to Newco, who incidentally have to pay a fee of about £850 to put their viability report to the pool, and whether it'll have any value to the creditors.
We've got a comment that somebody's posted up here about the phrase is marketing widely and there's marketing widely, and I think the inference of that is fairly clear. What does this really mean? And I think it's fair to say that we need to bear in mind that you need judgment to decide just what amount of marketing is required in any situation. As I touched on in an earlier slide, publicity about an administration can, in some circumstances, make the business less viable than it was before, and so you might not want to do what happened back in the early 90s, which is every business that went into receivership administration ended up being advertised in the Financial Times, and then 70 or 100 people would respond to that advert, and then we're having a few technical problems here at the moment, but I'll press on regardless. People would respond to those adverts, and then you will get your buyer or not. But if you've got a business which is the goodwill of which depends entirely on it not being public knowledge that the business has got a financial problem, then if you publicise it too widely that it's for sale, you're in danger of destroying it before you can sell it. So, but that said, you would normally expect that there might be one or two competitors who might be interested in buying the business, or possibly suppliers, or there might be a buying team who might want to acquire or whatever. So there is a balance to be struck here. I think what one has to bear in mind is two things. What's reasonable in terms of marketing to get you the best prospect of getting value for this business, and what's cost effective. And if all you've got to sell is a business which turns over 100,000 euros, you're not going to spend a huge amount of money and time trying to market that. It's not cost effective. If you've got a business turning over 15 million, I suggest you can't simply sell that back to the management without having conducted some sort of marketing activity, even if that's from not absolutely in the public domain. It has some element of covertness about it, but it is targeting the people most likely to want to buy the business, which after all is what would happen in a solvent company, in an arm's length, willing buyer, willing seller transaction.
Thanks, Peter. Moving on from the safeguards, I suppose, how can you mitigate the impact of an administration on your business? Now, the best way to avoid being affected by a PPAC is obviously to avoid being a creditor in the first place. And there are several things you as a business can do to reduce or mitigate the risk of being left unpaid. When taking on a new customer, credit ratings are obviously useful, but they are of course based on old information and could be out of date, although the presence of CCJs is obviously a sign that the business has unpaid debts. Importantly, robust credit control, and that's both chasing and overdue payments and also agreeing appropriate credit terms at the outset, or indeed not offering credit at all to a new customer, is worth reviewing. And it's also worth keeping under review as things change in your customers' businesses. Now, in terms of customer concentration, if you rely on one large customer, the impact of their failure on your business may be more serious. And similarly, if your customers rely on one major contract, then the risk of that being brought through to you, it also increases. Aside from review of credit, a regular dialogue with your customers is always important, and then you will also recognise when they stop speaking to you. If you can't get hold of your normal contact, there may be a problem with paying the debt, and that's something you might want to look at, and that might be a trigger to start reviewing the credit terms. Companies' house filings, such as late accounts, give an indication as to how a business is managed. It's actually possible for a very small fee to get an automatic update from Companies House on any company straight to your inbox. And also, if the company is of a size, trade or financial press may contain indicators that a business is facing difficulties. Now, if you have an enforceable retention of title clause in your terms and conditions, this will allow you to recover goods which are unpaid. And it's important to ensure that the ROT clause is valid. It's quite a technical area to make sure that they're properly incorporated into your terms and into your contract you have with your customers. And we would recommend you get a solicitor to assist you. It's probably one of those things where you spend a little bit of money up front and it could save you a lot of money in the long run. Credit insurance is obviously an option for some industries. And further, if the directors of your customer are willing to provide a personal guarantee, that does provide an alternate route to recover any shortfall, although that would depend on the financial status of those directors personally. Now, should the worst happen and one of your customers go into administration or any other procedure for that matter, it's nearly always worth engaging in the administration process, even if it is to just submit a proof of debt form. That's the one-page form you'll receive in the post. It lodges your claim, and if any dividend were to be paid, it would mean they would contact you and you would be entitled to receive some money. Now, beyond that, larger creditors by value could also have a significant input into the process of the administration. We find creditor engagement is relatively low, and so if a creditor with a large claim was to get engaged, you could have a relatively large say. Whether you choose to give a new company a new code credit following a pre-pack is obviously entirely up to yourselves, and whether or not they have a statement from the pre-pack pool will be interesting to see if that affects judgment of creditors who've been stung once, so to speak. but it may be that a properly funded purchaser, whether that be from a third party or a connected party, actually has better covenants than the existing business did. And so you may actually be in a stronger position giving credit going forward. I think now we're going to, before we move on to Peter's penultimate slide, we're going to run another poll. And the question on this one actually is, would you be interested in the opportunity to buy a business out of a pre-pack administration? So if you could vote either yes or no, it'd be interesting to see the results on that. And following the outcome, Peter's actually going to go into some more detail about pre-pack opportunities as a purchaser.
This is looking quite interesting as the results are coming in, but just whilst we wait for those, I think one interesting issue about the pre-pack pool is, this is being brought in by government. The most pervasive creditor in insolvencies across the board is HMRC. And I would be particularly interested to know whether HMRC take any interest whatsoever in whether a connected buyer in a pre-pack has sought a pre-pack pool opinion on their viability, and if they have, what that report says, or whether actually they just won't bother. Maybe I'm a bit of a cynic, but my suspicion is that HMRC will not take that much interest in that, and then you have to say to yourself, well, where is the logic in that? If government wants this to come in, shouldn't government ensure that its role as a creditor is such that it takes notice of what the pool says? Right, well, we have a 2/3, 1/3 split. So 2/3 of people that would be interested in acquiring a business out of pre-pack, and 1/3 wouldn't. So let's have a look at what that entails. Well, if you're buying a business or a company which is for sale on an arm's length basis, it's a perfectly profitable business, you will look for a lot of safeguards from the vendors by way of information. That you'll seek warranties about ownership of the assets, the reliability of the accounts, a whole raft of issues, tax affairs and so on, against which the vendors will make disclosures if they can't give the warranty which you seek. So if you say, I want you to warrant that you have title to your freehold property, and they say, well, we do have title to it, but there are certain easements or rights of access over it or whatever, then that's how you find out about that. If that then leads to you to feel there's a financial risk somewhere on a particular matter, then you can ask the vendors to indemnify you against that risk. Well, in administration, none of that happens. This is all a much more truncated process. So one might be doing a deal over a matter of a week or two, or sometimes even days. If you've got an advertising agency, for instance, you wouldn't even have weeks to sell that business. Or fruit and veg business is usually sold overnight. And when I say that, there is nothing new about this. We may have this new phrase pre-pack, but fruit and veg businesses have been sold overnight since I got into this line of work, well, more years ago than I care to allude to. But it is something that, as the buyer, you need to be alert to, that you will not get the same sort of assurances on a purchase from an administrator that you would get in an ordinary transaction. The next point is, and it's linked in a way, administrators will sell you only such right, title and interest as the company has in the parcel of assets that you think you're going to buy. So if you think that this Heidelberg press, which we touched on earlier, is owned outright by the company, and you price your bid to purchase the business by reference to the fact that that is an unencumbered asset, and the week after you've bought it, in comes a leasing company, so well, actually we own that asset, that's your problem. You can't go back to the administrator and say, well, I want a price adjustment on this, because he will say, I'm sorry, that wasn't the basis on which I sold to you. I didn't give you any warranties, I didn't make any representations. You bought this on a caveat emptor basis. I'm sorry if it now emerges that this asset was on finance, but that was the risk you took. The next risk is employment risk, which we touched briefly on the impact of the transfer of undertaking protection of employment regulations. But you will take on, whether you like it or not, the employees of the business on the terms and conditions which they are employed on currently. So if they have lavish contracts which overpay them, then you will have to adopt those contracts. If there were any redundancies made prior to the sale to you of the business, and those did not fully comply with the obligations to consult either on redundancy or on the sale of the business, there is a risk that there could be unfair dismissal claims, which, because the company administration can't pay them, could be visited upon you as the purchaser. So you need to be alert to that risk, and most bidders will look to discount their purchase price by that risk. You should be able to get the information to quantify that risk from the administrator waiting before the purchase, but it is something you need to keep in mind. And one of the problems with this is that if the business is not bought, the administrator will not pay those amounts out as an expense of the administration. There will be claims in the estate. So you can end up with a situation where the value of the business, if sold as a going concern, becomes less than the value of the business if it's broken up, which is completely perverse, but that's how TUPE works in these situations. Next issue is due diligence. I've touched on the fact that these deals are done quickly. You get limited scope to due diligence. You're probably not going to get much, if any, opportunity to talk to customers about whether they'll continue to deal with you. And so, it's important that what you do is effective, but you have to be alert to the fact you cannot conduct the same level of inquiry that you would have done in other circumstances. And then the final point is customer retention. How do you know you're going to keep these customers if you get so little time to get acquainted with what you're acquiring? Now, all these are risk factors, all a bit off-putting, but ultimately these all come down to two simple issues. Price, how much you're going to pay. You're buying in a distressed situation, you should be paying a cheap price, which is why people are interested in these opportunities, and the terms of payment. So particularly if you're worried about customer retention, you would look to link as much of the purchase price as you can to a deferred element. And gone are the days when, as administrators, we used to expect to be paid cash and were paid cash, and increasingly the sorts of deals that we have to do involve some sort of earn out, perhaps by reference to the turnover of the business in the 12 months after purchase or some other factor. So please be alert to these opportunities, but equally be alert to the risks, and if you're in doubt, I would always say take advice. And that, I think, brings us to a conclusion of what we want to talk about. We'd be happy to take any questions. If anybody has a question which they want to type out. I see we've got a comment there about TUPE. TUPE might make for a good future webinar. Oh, okay, well, we'll certainly keep that in mind. Happy to do that. What's that?
I don't know if anybody else has got any questions.
Oh, we've got a nice response there. Thank you very much. Well, I think we would wrap up by saying you've got our contact details there. We are here to help. There are two sides to the insolvency equation. There is the difficulty of a company that hits the problems, and there are the opportunities that flow for potential acquirers out of that. And if you want advice about potential acquisition opportunities, we'd be very happy to talk to you. If you want advice about a customer who you may be troubled about, equally we'd be delighted to talk to you about that. Can I thank everybody for coming? I'd like to thank Lizzie from our team for driving the technology, and hopefully we'll see you again on the webinar soon. Thank you very much.